Warm welcome to the webinar with this lovely, glorious weather. I think this is certainly what's helping us all get through these challenging times. I hope you're well, your families are well, and surviving to get through this this lockdown period. See, thoughts go out to Boris and his family today. I'm sure he's pulling through, which is good. But yeah, so thank you very much for joining. Think it's important to keep doing face-to-face discussions throughout this time, so we can all keep up to date with what's going on in the world. And on our part here at Enness, especially, feel that it's good to keep you updated with what's happening in the mortgage world. So I think I'll really kick things off by just giving a bit of a background with the company and what we're about at Enness and where we really sit within the market. I've been with the company for 5 years now, and it's been an absolute roller coaster in so many great ways, because the transformation of our business in this short time has really been on a real global scale. Back when I started at Enness, we were just one office in Mayfair. We've now got offices based in Monaco, Dubai, recently Jersey as well, and we're looking at doing Geneva as well in the coming months. So that's quite exciting, really. I think why we've moved on a global scale in the last few years, definitely with Brexit happening, although with everything going on, that seems to be a bit of a distant memory now. Our business has really gone international, and we're looking to really expand on getting clients' mortgages in Europe, looking at very international clients looking to purchase in the UK. Some clients never set foot in the UK, and by having the lenders available to us, so not just the high street banks, but certainly the private investment banks, specialist lenders, commercial lending as well, bridging finance and second charges. It's really by having presences in those different countries has really allowed us to expand our reach on a global scale. So that's a little bit about what we do, and thank you again for joining me on this topic that I really want to talk about today, and I think is very relevant, given that the purchasing in the UK at the moment has slowed somewhat, given the advice for valuers not to go out to properties and just to kind of slow that sector of the market down. So I think remortgaging, as I say, is very relevant at the moment to talk about. So first of all, just to give you a bit of a snapshot of what a remortgage is. A remortgage is essentially a client that has an existing mortgage with a provider, and they've either come to, in most cases, the end of their product term, and they're looking to shop around for a cheaper rate and do a like-for-like borrowing against what they currently owe. That's what we see the most of, I guess. But also clients may be on a tracker product, and they feel that with moving, especially in the last few years, we've seen such uncertainty in the market. We've had a few clients looking to try and move on to a fixed term, be it for 2 years, 5 years, or even 10 years, to get a bit more security against their borrowing, which we can still look at doing that type of thing. Again, it helps if you haven't got any early repayment charges, so you could actually come away from your product within before your product expires. But more often than not as well, we also see clients not only looking to remortgage, but actually raise additional borrowing and take out some of the equity from their property. This can be for a whole manner of reasons. Primarily, I guess, what we see the most of is clients looking to carry out home improvements. While the market's been moving a bit slower within the last few years, and people maybe not necessarily moving home so quickly, we've seen a lot of clients actually staying in their residence, increasing their borrowing, and actually increasing the size of the family home, doing home improvements. Or as well, we find clients that want to expand their portfolio, so they'll raise money against a property, be it whether it's a buy to let or a resident, to then purchase an additional property, again, be it could be for their son, daughter, or extending their portfolio. There's many other reasons of which somebody would actually take money out of their property, but those, I guess, would be your main kind of reasons. So that's typically why someone would remortgage. But I guess the question that would be more so on everybody's minds at the moment would be, is now the right time to mortgage? We've been asked that question a lot in the last few weeks. Naturally, we've seen big changes in the economy, with a lot of things slowing down. We've seen changes with the lenders' approach to their appetite in the last few weeks. So while I think there's been a lot of changes, I still think there's a lot of positivity in the market when it comes to remortgaging. I think lenders are very much realizing that purchases are slowing for the time being, although I don't think, whereas they have dropped their loan to values for purchases in the last few weeks to 60% as a pretty average kind of loan to value. I think what we're hearing is that will be quite a short-term thing, but I think certainly on the remortgage side, we're still seeing lenders offering those higher loan to values that we were previously able to get our clients in the last few months, and moving back a few years as well. So I think lenders realize that they need to still lend. I think there's a lot of liquidity there. I also think with the Bank of England base rate being so low, it's a great chance to get some real bottom line products. And I'll go into talk a little bit more about the products that we can offer at the moment. They are really fantastic opportunities out there. So it is really, I think, a good time to start looking at, maybe while you've got a little bit of time at home, if you don't feel like you're necessarily on the cheapest rate, you've been thinking about increasing some borrowing, but you're not sure about the uncertainty. I think there are those products out there, 2 years, 5-year fix, 10-year fix, that can give you that longer term security as well if you're worried about the future. And it can be a good time to just review your finances and look at that. I think what, again, we can talk about, and I think what's important for me to break down here, because of the range of clients we have, and again, we've got that luxury of looking at the open market, is maybe just giving you a bit of an overview of the different types of lending out there and what people are offering across the lenders that we have available to us. Again, it's not going to fit everybody, but again, we have access to quite a wide range, so we can usually cater for most clients. Obviously, some banks have been a bit more restrictive in what they're offering, but there's still some very good loan to values, which I'll talk you through now. So if we start with the private bank side of things, again, this would be a client looking to usually borrow around £1 million plus. This is where the kind of entry level for private banks are. There's a few that go a little bit lower, but for the right client, they'll definitely look to go potentially a little bit lower if they can see a long-term relationship available. With private banks, historically, I think the big question is will they lend just a mortgage, a standard loan without a wider relationship? If we're taking it back about 3 or 4 years, it was quite difficult. It was still possible, but it was quite difficult to get certainly a higher loan to value or just a straightforward remortgage through a private bank without them wanting a wider relationship. Naturally, private investment banks make a lot of their margins from requiring clients to invest as well. And sorry, I just lost the screen a bit there. Okay, so lots of so previously we'd have a lot of private banks would need that wider relationship, so it was quite a struggle, and especially when clients looking to remortgage as well. when a client's looking to remortgage as well, it can be quite frustrating, you know, putting that wider relationship down with the bank, because they're either trying to increase liquidity out of the property or just obtain a rate, and quite often they've already got existing relationships with other banks. So what we've seen in the last year or two is private banks are moving a lot more towards dry lending, so just a straightforward mortgage, and also bringing down those rates, but as well increasing the loan to values they're offering, which has been really positive, and it's helped us to secure a lot more deals, and it's just increasing the amount of opportunities for clients to remortgage. Private banks we would typically go to as well, aside from the high street, because they do operate in that higher lending space, but also they're very good at dealing with overseas clients. So even, like I say, clients that have never set foot in the UK or don't have a UK footprint, they're very good at clients that have foreign currency income, quite complex income structures, either lending to an offshore company rather than putting the property in their own names, but also the actual like company lending as well. So it's very helpful, and it's a very good sector of the market. If we're looking at current remortgage rates offered by private banks in this current market, we've actually seen some really good reductions. So not to throw too many numbers at you, but to give you a bit of a flavour, we've got 2-year tracker rates at 1.49% plus Bank of England base rate, which is currently 0.1%. So a 1.59% rate all in, which is pretty phenomenal. I mean, that rate about 2-3 months ago was over or around 2%. So you can just see how things have come down there. Got 2-year fixed rate products at 1.89%. These rates are for loan to values up to 60%. I'm going to go on and talk to you about how we get those higher loan to values in a moment, but certainly for a 60% loan to value product, it's very low. A 5-year fixed as well at 2.14%, and a 10-year fixed at 2.54. So to have that comfort and stability for 10 years borrowing on your refinance, it is very, very, very competitive, and will give a lot of people peace of mind with their mortgage. Moving up to 85%, and again, this is actually, we can still secure this, believe it or not, on loan sizes of up to 5 million. So 85% loan to value. Again, affordability at these stages do get looked at quite a lot more in depth. So the income and expenditure is looked at more, but it's definitely still possible to get 85% loan to value on your residence at that level. So the 2-year tracker, again, 2.19% all in. A 2-year fixed is 2.49%. A 5-year fixed is 2.74%, and a 10-year fixed at 3.14%. Again, still very, very competitive, and really encouraging that lenders are looking to still consider these sort of loan to values at present. Moving on to, again, just one point to point out on that, at 85%, you can still look to do 65% of that loan interest only. So it just helps keep those monthly payments lower. And then the additional amount of the mortgage would be on capital and interest. So you'd still be reclining, decreasing that loan size over the term of the mortgage. Moving on to buy to let. On the private banking side, we can still get lending of up to 75%, again, above $1 million. So this would be a loan size of a maximum of 3 million. We can get mortgages approved still higher than that, but the loan to values would slightly come down a bit. At 75% loan to value, though, up to 3 million, we'd be looking at a 2-year fixed of 2.54, a 5-year fixed of 2.79, and a 10-year fixed of 3.14. So again, pretty competitive. Moving on to the high street banks, I'm more so high street, or just a bit more kind of below the £1 million mark, but not private bank lending or specialist lending. I just wanted to give you a little bit of a flavour for exactly how low the rates can still go at the moment, while still obtaining higher loan to values. I think there, like I said at the start of this, there has been a lot of movement on the loan to values on the purchasing side from the high streets, and some lenders stopping accepting applications. However, the remortgage side of things does still look very very positive. So for example, lending of up to 500,000, we can get 85% loan to value still. So 1.49% for a 2-year fixed, and then a 5-year fixed at 1.89. 80% loan to value is still possible up to £1 million. Again, the rates are just slightly different on the 5-year fixed there. So because it's actually a lower loan to value, you actually get a better rate, even though the loan size is high, which is great. So you get a 1.44% 2-year fixed and a 1.74% 5-year fixed. You actually get, I think what's nice as well is we're seeing lenders offering good packages, again, which I think is quite encouraging. So you're seeing free legal and free valuation is given as an option for a lot of these refinances. I know you'll probably hear the word valuation comes then, and I think the immediate question is but how do you actually process the mortgage at the moment with valuers not necessarily able to go out to the property, which is something I'll come on to, and talk about in a moment, because I think that is something that's quite I think being dealt with quite well from the banks, and I think we're seeing quite immediate responses on that. And I think it just shows that we're still looking to move things forward. But just to kind of finalise on the rate point of view, a buy-to-let mortgage under £1 million, we're still looking at lending of up to 75% loan to value, 2-year fixed at 1.74 and a 5-year fixed at 1.94. And the mortgages here on the buy-to-let side of things would be again on a full interest only basis. On the residential side, under £1 million, when we're going up to those loan to values, typically because it's a client's primary residence, the banks really want to see capital and interest rather than interest only. We can provide a longer term, so sometimes 35, 40 years, which can help keep those monthly payments down if it's right for the client. But certainly at a high loan to value, the banks just need to cover themselves slightly by having a repayment mortgage in place. So moving on to valuations, which again is a hot topic because, and I think it's kind of seeing what can be done and what can't be done and what needs to be put on hold at the moment, really, with mortgages. So yes, a lot. It's true that most banks are not able to send out valuers at the moment, which has to a degree slowed things. That is true. However, again, starting with the private bank side, the rates that I quoted you with, we can look at doing desktop valuations. So that's a valuer not having to actually visit the property. They use their internal systems and recent property price sales and their own ways of things, do it from actually office based, so we can actually get a valuation done there. I've got a client at the moment who's based overseas, purchasing a property at 2.9 million. Luckily, we're also refinancing her property with the same bank to raise money to then put down as a deposit on the new place. We're still actually able to move forward with that. Again, with a private bank, it's nice because you haven't got the slow wait times and it's not system driven. You're able to speak with a banker directly. You've got inline straight access through to the credit committee, so we're able to move things forward still, and I think that deal will actually complete potentially a bit quicker because we don't need to send a surveyor out. So perhaps this may be a good insight of how things can be changed moving forward. Maybe we'll be able to, when we come out of this lockdown period, we'll see lenders might be looking at, we don't know this for sure, but hopefully there might become a bit of a different attitude and a bit of a quicker way of doing things when it's a more straightforward property with valuations in the future. So like I said, with that deal, we'll be able to still complete the remortgage. Again, with loan sizes over 3 million with that particular bank, I think although we can't actually go out and do the valuations and there may be a bit of a lag there, it's still definitely worth looking to start the process of a refinance because like I said, it's a good time to secure that cheaper product while things are low. We can also go through the credit approval process, and we can also get the account opening done all up front. That way, when the lockdown's lifted, we can then book the valuations and we can start to progress matters. So I think, like I said, while everything's a bit on lockdown, banks are still very much lending. I think there are a lot of positives that we can take away from this, which is what I think we need to do in these times. And I also just think that, like I said, it's all about, whilst we do have a bit of time, maybe you're sat at home, we can start progressing your remortgage. And then when it gets to that point of valuation, we can just hold off until the valuers are able to go out again. So yeah, I think there's a lot of positives to take away from that, especially on the high street side of things and the more kind of standard lending and under $1 million. With a few of these banks and the ones that I pitched you with, again at the higher loan to values, if the property is a bit unique, it's hard to get an online desktop valuation done, but they will certainly, if it's a property that's been valued recently, or if it is a bit more of a straightforward property, banks will definitely look to try and do an online valuation where possible. But again, same principle with the private banks, even if they aren't. I've got a few of my clients at the moment that I've put with a few specialist lenders and the more kind of high streety lenders. We're just doing all of that underwriting process up front, decision in principles, and then we get to the point of valuation, which can be done then immediately once the lockdown's lifted, and then mortgage offer is produced, and then you can complete on your mortgage. So that's all I really wanted to cover off, without going into to too much more detail. And I just wanted to raise those points and give you a bit of food for thought. If you do want to discuss anything more, my team and myself, we are available round the clock, weekends as well, and we're definitely looking at seeing ways that we can still help our clients. And it's clear that there are a lot of ways. I wouldn't say for a minute it's exactly business as it usually is, but I think what we saw happen, obviously, Brexit slowed things down, but what I think was really encouraging is that at the start of this year, everybody had been holding off for the last 3 years. Families that just haven't upsized the family home but needed to, but wanted a bit more security after Brexit, just not having as much stock on the market, and quite a lot of reasons for people holding off. I think at the start of this year, we really started to see people moving on properties. I had one client offering on a property. I was hearing that it was going to best and finals, and I think 8 other people were putting an offer on that same property. So best and finals isn't something I've heard happening for about 3 years. So it was really encouraging to see that movement straight away in the market. Obviously, it's very unfortunate what's happened in this current period, but I think those buyers are still very much there. I'm having a lot of positive conversations with clients that still want to keep things, or quite actively looking to buy as soon as the things get a little bit more positive again. So, and I think, like I said, with lenders reducing their loan to values, I think it's definitely a temporary thing. Obviously, I can't say how things are going to go, but yeah. If you do have any questions for me, my contact number is I don't know if you want to take this down, 077 920 49243, and I'm available on WhatsApp. And if you want to email me, it's chris.lloyd, Lloyd, at enness.co.uk. Finally, I think we'll just go, there's a Q&A question. Do you think remortgaging and mortgages are going to become more important now that landlords will have to look at their cash flow more careful now, as they must pay their capital gains tax within 30 days of a property sale? Yeah, I've had a lot of conversations with landlords, especially my larger landlords with big portfolios in the last few weeks. I think it's definitely been a big concern. I think not even just the capital gains tax point, but I think, well, actually one of my clients mentioned that yesterday, in fact, just on the phone. But I think it's just increasing liquidity and just giving themselves a bit more of a buffer there. But I think, but yeah, we're seeing quite a lot of landlords start talking about this capital gains tax. Yeah, and I think that is definitely a question I'm seeing a lot. Okay, so if there isn't any questions, I will end this one now. But thank you so much again for taking part, and